Hello all, welcome back to our channel. In this video, we are going to discuss about earnings per share in detail. Imagine two companies, both report a profit of $1 lakh, but one company reports EPS of $5 while the other company reports EPS of $2. Same profit, but why different EPS? How is that possible? That's exactly what we are going to understand today. EPS stands for earning price per share and it is one of the most important profitability measures in financial statement analysis. EPS tells us how much profit belongs to each common share. Instead of just looking at total company profit, EPS allows investor to understand profit on per share basis. Now let's look at the formula. EPS is equal to net income minus preference dividend divided by weighted average shares outstanding. If a company has preferred shareholders, we subtract preferred dividend first because those earnings do not belong to common shareholders. Now let's understand this with a simple example. Suppose a company reports net income of $1,20,000, preferred dividends $20,000, weighted average shares outstanding is equal to 25,000. First, calculate profit available to common shareholders. $1,20,000 minus $20,000 is equal to $1 lakh. This profit is attributable to the common shareholders. Now divide this number by number of shares. Therefore, we get the EPS as $4. So the company's EPS is 4 per share. This means each share represents $4 of earnings. Now here is something very important for the CFA exam. The formula uses weighted average shares outstanding, not just the ending number of shares. Why? Because companies can issue new shares or buyback shares during the year. So we must adjust the shares based on how long they were outstanding. Let's look at a simple example. Suppose a company had 10,000 shares at the beginning of the year. After 6 months, it issued 4,000 new shares. So the shares were for the first 6 months 10,000 shares and next 6 months it is 14,000 shares. Now we calculate the weighted average. 10,000 into 6 divided by 12 is equal to 5,000 and 14,000 into 6 divided by 12 is equal to 7,000. So the weighted average shares is equal to 5,000 plus 7,000. Therefore it is 12,000 shares. This type of calculation is very common in CFA exam questions. Now let's move to another important concept. In CFA Level 1, you will also see questions on diluted EPS. Basic EPS uses the current number of common shares outstanding, but diluted EPS assumes that certain securities may convert into common shares in the future. Example includes stock option, convertible bonds, convertible preferred shares. If these securities convert, the number of shares increases. And when shares increases, EPS usually decreases. That is why diluted EPS is sometimes called the worst case EPS for existing shareholders. Let's see a simple example. Suppose a company reports net income of $1 lakh and the shares outstanding would be 20,000. In this case, the basic EPS is equal to 1 lakh divided by 20,000. Therefore, the basic EPS is $5. Now imagine there are 5,000 convertible shares. If they convert, total shares become 20,000 plus 5,000 is equal to 25,000 shares. So in this case, diluted EPS becomes 1 lakh divided by 20,000 is equal to $4. Notice what happened. Profit didn't change, but because the number of shares increased, EPS fell from $5 to $4. And this type of calculation is very commonly tested in the CFA exam. Now let's recap quickly. EPS stands for earnings per share. It measures how profit belongs to each common share. The formula is EPS is equal to net income minus preference dividend divided by weighted average shares outstanding. Basic EPS uses current shares. Diluted EPS assumes additional shares from convertible securities. And remember these key ideas. Higher earning increases EPS and more share reduces EPS. That is why EPS is one of the most closely watched numbers by investors, analysts, and CFA candidates. Thank you.